Awesome. Looks like we are live. Welcome everybody to the first YouTube stream that we're doing like this. Um, so we're here with Copper, and we're here with Mr. Takatoshi Shibayama, and who is the head of sales of APAC at Copper. How are you doing, Taka? Thanks for coming on and taking the time to chat with us.
Yeah, thank you very much for inviting me. The pleasure's all mine.
Awesome. So yeah, we're just going to do a little kind of discussion today, talking about kind of bridging the gap between TradFi and crypto custody. As many people know, doing some of this off-chain or maybe secondary party custody of crypto assets is becoming more and more important. It's I think a big step towards getting a lot more institutional adoption in the space. So I guess let's I guess let's start at the top. Let's start about like a little bit about you, your background, how you got started at Copper, and then would love to dive into kind of some of the things you guys are working on.
Cool. So I've worked in traditional finance for quite some time, about 20 years. First started off in proprietary investment teams in investment banks, investing in distressed assets, what we call special situations of corporates. And I did that all the way up until Lehman crisis. And then afterwards, all those proprietary investments were gone from investment banks. So I moved over to the hedge fund space where I worked as an analyst, worked my way up into a portfolio manager, and I even had my own hedge fund that focused on value investing and deep value across Japanese equities and credit. And I did that for several years, grew the fund from a $200 million of AUM to $1 billion. And now it's around 2 billion, I think. And then, during that time when I was working in hedge funds, I really got interested in the concept of crypto, creating this, alternative financial system that is away from governments and speaking to a crowd where, people who live in countries where they experience hyperinflation, capital restrictions, and their freedom being taken away from the financial system, and then bringing them into an alternative financial ecosystem. So that is something that I really feel passionate about still. And that's how I kind of got into the space and, buying my first Bitcoin and going down the rabbit hole. And then I really wanted to make the move over as I was kind of maturing and into the hedge fund space. And I thought, well, rather than going into, crypto trading myself, because that's not really what I used to do. I mean, as you can imagine, in value investing and crypto trading has nothing to do with each other. So I thought, okay, well, I see gaps in the crypto industry, the crypto infrastructure, and how can I place my knowledge, my experience into this crypto industry where I can transition from a traditional finance background into crypto. And I saw, as I mentioned, there's a lot of gaps in the infrastructure, and particularly the custody space, where there aren't any custody providers that actually work well with the trading firms. There were a lot of custody providers or even self-custody providers in that space, but nothing really kind of spoke to me where it was actually transferable from the traditional finance. And as you know, exchanges take on the task of doing custody, prime brokerage, clearinghouse, and exchanges all at the same time. And that needed to kind of be separated away. And I could go into that a little bit more in detail, but, I thought that the custody space was something that was a huge gap. And I placed myself in Copper because they had the products and the ethos that aligned with me.
Wow, it sounds like you have a lot of experience in this kind of section, combining in kind of the flow from TradFi into crypto. So it makes a lot of sense as to why you're doing a lot of the things that you're doing. Super interesting background. I'd love to go a little bit and start very high level, and then love to kind of work a little bit deeper in. So for the audience that doesn't know, can you kind of walk us through the basics of like what is kind of crypto custody, and why is this like important for a lot of different institutions, and who are the kind of institutions that this is kind of perfect for?
Sure. So crypto custody is a business. And let me take the custody side in the TradFi space. So as a hedge fund, and these are the type of people that would look for custody, right? In an institutional space, I want to invest in the crypto asset class, and what I would usually do as a hedge fund, if I was in the traditional finance space, is look for a prime broker. So I'll go to a Morgan Stanley or Goldman Sachs, whoever they are. Back in my old shop, I used to have Morgan Stanley and Nomura as my prime brokers. So I'll have a contract with prime brokers so that they'll give me access to investing in whatever I'm investing. And then with that contract, it comes along with custody providers as well. So I would keep my assets with custody providers. And then when I make my trade, I'll go to my prime broker, place a trade, and then they'll have access to clearing houses and subsequently the exchanges. So if I wanted to, let's say, buy Apple shares, or I want to sell a certain commodity for something else, or whatever they may be, I place it to a prime broker. Now, all these players that I just mentioned, the custody, the prime brokers, the clearinghouse, the exchanges, as I mentioned, they're all kind of lumped up in the centralized exchanges, and they're taking a very huge concentrated hedge funds are taking huge concentrated risk at a centralized exchange, because all the duties that you would normally see in the traditional finance space is in the actually the exchanges are doing that, and by no fault, it's their problem, because the industry never really developed those kind of players in the beginning, so the exchanges had to do everything. Now, as the institutional investors, like your hedge funds of the world, that have fiducial duties to their investors to keep assets safe and provide the returns that they promise to their investors, they need to find all these type of players to make everything happen. They have to tell their investors that this is the custodian that I'm working with, this is the prime broker that I'm working with, all these things. So for them, going to their investors and saying, oh, well, I'm going to leave all my funds on an exchange. The prime broker is the exchange, and everything that I need to do is all on the exchange, is not going to sit very well with their investors. So therefore, you need various players to be in this industry to make sure that their investors are happily investing in them and guaranteeing them that their assets are safe somewhere that is outside of the exchanges. So that's why the crypto custodians come into place. They will hold crypto assets for their investors, and the institutional hedge funds would actually access that custodian in order to place trades with an exchange. So that is the most important part for most of the investors, because they know that crypto assets are extremely volatile. They could be hacked. Exchanges can be hacked. They can go insolvent, etc. So they need to know that their assets are held by a third party service provider to make sure that the assets don't go missing. Ishan, you are muted.
There you go. Sorry. So I think now is kind of a better time than any to kind of really think about diversification of risk, right? Whether it's banks and TradFi that we're seeing that maybe you should start to diversify a little bit in who's holding your money, to definitely crypto assets where there's just counterparty risk across the board. So why should users really look at third party custody over the traditional kind of nuances that people talk about, which is like the importance of self custody and why everyone should just self custody all their assets?
Yeah, sure. I mean, it really depends on the requirements. I mean, if you're a retail investor, obviously you don't have access to crypto custodians. I mean, the barriers are very high. A lot of crypto custodians only service institutional clients. So unfortunately, that access to custodians are not there. So you might have to rely on a self-custody service, or a product like your Ledger Nanos and Tezos of the world. And then you will store your assets there, and then have to move your assets on chain to an exchange in order to perform a trade. Whereas institutional clients, they have a lot more options. They can choose self-custody, they can choose a third-party custodian. But the types of clients that I mentioned, the institutional clients that have fiducial obligations to their their investors will need to have a third-party custodian. Self-custody wouldn't be in the scope for a lot of these institutional investors. So therefore, there is a difference. If you're a market maker, or if you are a trading based on your proprietary capital, then you have options. You could go for a self-custody. You can use a third-party custodian. That's your choice. But it really depends on the trading firm's concept, I guess. You're muted again.
I'm going to get this. Don't worry. I think that makes a lot of sense, that there's a lot of regulatory requirements. So I'd love to kind of dive a little bit deeper into kind of the regulatory discussion. Like what do you kind of see as like the outlook on regulatory requirements? What does this mean for market players that they're kind of required to have these different custody requirements?
Yeah. So unfortunately, in the crypto space, there are not any regulations around crypto custody per se. There are virtual asset service provider licenses and registrations, etc., mostly around AML and KYC. But for crypto custody, as a specific industry, there's no regulations around it. So obviously, for companies like us, we have to in sort of way, we have to self-regulate ourselves to make sure that our practices are up to standard. Up to standard meaning as close to traditional finance as we can get. Obviously, there are nuanced differences in how digital assets are stored versus traditional securities. And then we, as a crypto custodian, work more like a cybersecurity company than anything. That is our first and foremost, importance of safekeeping our assets, because we have cyber attacks from everywhere. As you can imagine, if we have billions of assets stored in our custody, it'll be any hacker's dream to be able to access that crypto custodian and hack those assets. So, our security team are working 24/7 to make sure that those cyber frauds and hacks won't happen. And on top of that, then we have to think about how do we get our trading firms, our clients, access to trading venues like your exchanges, your OTC brokers, the DeFi, staking, etc. And we have to build product suites in order to catch up to how the industry is developing. So it's a little bit different from how custodial banks work in the traditional finance space. But the way that we handle our clients, the way that we interact with our clients, service our clients, etc., these are on a kind of self-regulatory basis, but we try to keep it as top-notch standard as possible.
Yeah, I think everyone that's in the space is pretty weary of the potential for different hacks and things like that. So it's definitely something everybody's conscious about. So when you talk about crypto custody, I think that's kind of a maybe crypto custody itself is a little bit of a broad term. Could you talk us a little bit about what custody actually looks like what methods are available, and maybe give us some examples, just so the audience can kind of wrap their head around it a little bit better.
Yeah, sure. So if you think about your basic tools that we had previously, like your ledgers, right? So Ledger Nano is a device where you can store your private keys, you have the seed phrases, and you can keep your assets in there. So let's expand that from there. So let's say you want to bring that to a more institutional grade. There are products called hardware security modules. So basically that is a more advanced version of let's say a Ledger Nano, where it's a hard device where you can store your private keys. In order to access those keys, the custodial services will provide access to their institutional clients through a multi-signature process, meaning that, let's say, as a crypto custodian, I'll hold your private keys. If you want to access your assets, we'll do it like a video call, just like this, and then verify who's actually, on the other side, to make sure that this person is the authorized signatory to access those assets. And then we'll perform certain, ceremonies to access that asset, and then the investor can have access to the crypto assets. Now, in a in a world where institutional investors are coming, need to access their funds immediately because something is happening in the market, they have to trade 24/7, going onto a video call like this, and then doing all these ceremonies would take a lot more time, and then they have to move their funds on chain to an exchange. I mean, that all that stuff will take a lot of time, which doesn't increase your efficiency. So therefore, the industry has evolved a little bit to make that process smoother and quicker. So at Copper, we also use a technology called multi-party computation. This is a technology that was adopted from the it's a type of a cryptography that takes the private keys and then replaces them into what we call shards. And we can create multiple shards. At Copper, we have 3 shards. And then there'll be different people who will hold those shards. There'll be Copper, the client, and a trusted third party. Now, all 3 people will work together in order to create a wallet for our client. But on the day-to-day activities, it'll be Copper and the client having access to those shards and then signing the transactions in order to move the funds to a trading venue. And this process will take is pretty much automated at this space. I mean, obviously, if you want to move your assets from a safe custody, meaning cold wallets, then you have a manual process, which will take around 15 to 20 minutes in order to move your assets. However, if you're a market maker, if you're trading proprietary, or if you're doing high frequency stuff, obviously you don't want to do all that. So you'll have a more setup where you have like a hot wallet or a warm wallet, where you can automate that process as much as possible so that you have quicker access to your funds. Now, the custodians nowadays will provide access to trading venues that will have a certain security protocol in place that the customers will whitelist those external addresses so that the funds cannot move away from the whitelisted addresses, meaning that it will be contained within those whitelisted addresses, and it can't be siphoned away to an external address without authorizing it to be added in that whitelisted address. So that kind of prevents misappropriation of funds. So if you have like a rogue employee and then they send it to an exchange and they want to siphon that money away to their own personal wallet or external address, it prevents that from happening. Now this was something that the industry created, a few years ago. But at the same time, at Copper, we also developed this product where you don't even have to move your funds on chain to an exchange. You can actually keep your assets within Copper wallets and then have that balance reflected on the exchange, because Copper acts with the exchange as a collateral agent, and then the exchange trusts us that we have that collateral sitting with Copper so that they can credit that balance onto the exchange so that the clients can trade based on that balance. And then we can settle that inside Copper because we hold the assets from the exchange. I mean, so I could go into that a little bit deeper, but I just wanted to give you a flavor of how the industry has kind of evolved in terms of crypto custody, because there are a lot more developments within this industry. And our institutional clients want to have more access to trading venues, more access to various financial services that they can get as they can do in the traditional finance space as well.
Yeah, wow. There's a couple really key points that I want to highlight that you just brought up, which is one, MPC. Anyone that's been in the space for the last few years has been hearing about the promise of MPC, and in a more retail fashion, think of it as like kind of social recovery and a different way to kind of access funds. But I think the really cool thing is that, one, you guys are on the cutting edge of like this cross between kind of institutional security, operational security, cybersecurity. And then 2, I think the really cool thing is that these institutions still, you don't have to give on kind of access to your funds in exchange for security. You don't have to make that trade-off. I think that's one of the really cool benefits that Copper has, is that Copper is such a has such great relationships not only with institutions but also exchanges, so that they can kind of be that collateral middle ground where institutions can still keep a lot of their trading activity and some of the benefits that they have of being able to trade crypto at any time, without having to sacrifice any of that kind of operational security and not having to have that time gap as well. So I think that's a really interesting point. Um, that does bring a lot of the benefits that copper offers, but I want to go a little more broadly. When we think about crypto custody, right? Like these are some great advantages, right? You get the operational security while still kind of maintaining access. But what are some maybe like the disadvantages that people would maybe point out on kind of the institutional kind of crypto custody side?
Yeah. So when clients have, as I mentioned, the kind of a crypto custody as a third party, obviously they have to go through operational effort in order to access those funds, right? So if you have assets in cold custody, even though we developed a system where you can speed up that process, it still takes 15-20 minutes to get access to your funds. It's not automatic. So yes, if you leave your funds on an exchange, you can access it instantly. Everything's off chain. Everything sits in an omnibus wallet, and and then the settlements of trades are all off chain as well. So there's a lot more practicality in leaving funds on an exchange as opposed to a crypto custodian. So that's why we were trying to develop a system so that we can make these experiences seem very off-chain like as possible, so that the operational effort isn't as required as opposed to like moving on-chain from a custodian to an exchange and then bring it back into custody. So I think that those will be the disadvantages I can think about. Obviously, onboarding to an crypto custody service provider is very much like onboarding to a bank these days. I mean, there's a lot of AML, KYC that process that you have to go through. So obviously, if I look at across all of our clients that are going through this process, it could take anywhere from like a month to 2 months to make that happen. I mean, obviously, KYC into an exchange might not take that much time. So, there are operational difficulties in using a crypto custodian. But again, if you're a hedge fund and you have investors into in your fund and expecting you to safeguard their assets, there are obligations to even having to go through all that effort to make sure that the clients are happy with that process. So, there are there's pros and cons of having a crypto custodian, but you have to think about what is your end game, right? Are you there to satisfy your investors, or are you just looking for practicality? If you don't really care about if you don't have investors, if it's just your own proprietary capital, then maybe you choose practicality over security. So it really depends on the client.
Yeah, that makes a lot of sense, right? There's trade-offs all over the board, all over kind of the crypto industry. Is like there's constantly operational and viability trade-offs that you're making, and for the right institutions, it makes a lot of sense that you're kind of trading that lag time of being able to kind of execute versus the kind of having that level of operational and cybersecurity. So when you look at different custody institutions, such as copper, which aspects should you consider, or if I'm an institution, what should I really look at as far as choosing between kind of different providers?
Sure. So I mentioned about the practicality part. So I think a lot of institutional investors are thinking about, how do I get to access to trading venues as quickly as possible? So, if you're using let's say a hardware security module, like as I mentioned, like a glorified, Ledger Nano, sort of to say, then obviously, the practicality kind of goes away. If you're long only and you just want to store your assets at a custodian, and you just buy, crypto assets once in a while and just store it, then, I think that's fine, because it's not really, your need to access trading venues as quickly as possible. But if you're like a high frequency trader, or even a hedge fund that needs to access every day to an exchange, moving your assets from here to there and back again, obviously it's not really practical. So then what you would do is think about other service providers that is not focused so much on just storing assets, but giving you connectivity to exchanges and other financial services in the crypto space. So that's what you would start thinking about. Okay, who are the other providers that have access to that? So then you'll kind of narrow that quite a lot, and then you'll start looking at, okay, let's start thinking about, do I want self-custody? Do I want third-party custody? That's another thing. Then number two is what is the process in order to get access to my private key so that I can move my crypto assets? Is it an MPC provider? Is it a multi-sig type of process? And then you can narrow that down quite a lot. And then also then you start thinking about, okay, now that I've chose the security architecture, now what are the trading venues that I can get access to? Does this custodian have 50? Do they only have 3? Do they have do they have access to DeFi? Do they have access to OTC brokers so that I could do bulk trades, etc.? So then you start kind of narrowing it down into a few providers, and then in the end, look, I mean, if just putting back my hedge fund hat back on, ultimately it kind of boils down to, who do I get along with, which the crypto custodian can provide me the service, maybe soft service as opposed to hard service like these, product suites. But what are the other soft services that they can provide? Can they give me access to capital allocators? Can they give me access to, let's say, like a, can they give me access to, if I want to hire somebody, do they have like a long list of resumes that they can show me? All those kind of soft things to make sure that I can perform my operations as smoothly as possible.
Yeah, when you bring up kind of that bridging that gap between TradFi and crypto custody, I think that brings up a lot of different different points. The thing I'm really curious your take on is like, how does this crypto custody kind of concept, how does that kind of impact kind of the larger ability for mainstream adoption, right? How does it impact the ability for more funds, more traditional funds, to feel kind of maybe more comfortable with kind of stepping into the industry?
Yeah, well, actually, the existence of custodial services will accelerate the institutional adoption for sure. Because if you are leaving funds on an exchange and you have situations where the exchanges go insolvent and you lose access to your funds, or you completely lose it entirely, then obviously you cannot perform as a hedge fund to guarantee your clients safe custody of assets. So, the existence of crypto custodians in the first place is extremely important. I think the other things that are really important to grow this industry is to have more prime brokers. Prime brokers are the ones that give you access to leverage, give you access to direct access to exchanges without having to onboard to an exchange itself. There's a lot of nuances with the prime brokers that hedge funds would need to kind of get into this space. We experienced this ourselves when onboarding hedge funds as well. They want all these other prime services in order for them to grow their business in this space. And then there are nobody in this crypto industry that has a balance sheet like Morgan Stanley's and the Goldman Sachs of this world, right? Even if you combine all the crypto lenders of this world, it doesn't even match the size of a Morgan Stanley. So, I think this industry needs a lot more growth is in order to adopt the institutional investors to come into this space and then allow them to kind of flourish. So obviously this is a nascent industry and we're only one step into it, where we're starting to move the custodial elements, move the clearinghouse elements out of the exchanges, and then we can start thinking about what other prime services or other services that we can provide to institutional investors.
Yeah, it's really interesting to think about how we need a lot of the same kind of traditional TradFi infrastructure in order to really grow the industry. And I think you bring up a great point about Morgan Stanley and Goldman. We don't even have you put the entire kind of market together, and you're not even getting like fractions of balance sheets. So
Exactly.
I think there's a long way to go, and I think this is a huge step in having the institutions feel more comfortable holding more on their balance sheet through kind of custodians like you guys, like Copper. So I want to dive a little bit. Okay, so before we dive deeper into copper, I want the audience to be able to get an idea of like what does the kind of like if a client is going to onboard with copper, what does that onboarding process look like? From kind of being interested, and you kind of mentioned that 1 to 2 month cycle of KYC and AML and registration. So what does that process look like for a traditional institution?
Yeah, I mean, just as you said, I mean, you have to provide a KYC document. So we need to know like your source of wealth, who are the authorized signatories of the company, who's the ultimate beneficiary owners of the company, etc. There's a whole list of documents that we have to ask for our clients in order to onboard with a custodian, and primarily because we are also under a registration under a regulatory body to make sure that the AML KYC policies are exactly the same as traditional finance. So that process, as tedious as it might sound, is something necessary to make sure that, when institutional on board with us, all the funds that are sitting with copper is not, with tainted money, so to say. They're not involved in illicit activities. It's not part of, terrorist finance. It's not money laundering, etc. And all the assets they're, kind of onboarding with copper is not involved in any of those activities.
Yeah, I think over the past couple of weeks, we've seen a lot of crackdown on some exchanges that we won't dive too deep in about some of these same some of these same reports about not having the clearest ideas about where this money is coming from, and not having a lot of that anti-money laundering practices in place. I think that's really a really key piece for getting more governments behind supporting some of the crypto adoption that's happening not just in the U.S. but really all over the world, especially in APAC, where we're seeing insane growth there. But you bring up the topic of registrations. I'd love to get a little bit deeper of an idea of what kind of licenses or regulatory registrations and requirements do you guys face? I know this might not be the most fun topic, but I think it is a really important topic to kind of dig a little deeper on.
Yeah, as I mentioned earlier, there are no licenses for crypto custody per se. There are frameworks around qualified custodian in the U.S. That our peers have, but in the grand scheme of things in general, there are no crypto custody licenses. So therefore, we have to abide by something similar or something that's available. And one of the things that we are provided with is AML and KYC policies. So therefore, we can go under any type of financial regulatory body and then abide by its rules to make sure that at least the AML and KYC policies that we have in place are aligned with that regulatory authority. So that's the most that we can do at this point. But as the industry grows, as the regulatory bodies start to understand this industry much better, maybe they will step forward to provide those guidances. But at the time being, we could only deal with the things that we're provided with.
Yeah, I think those are really important assurances that I'm sure a lot of your clients look for. And I want to touch on another type of assurance that maybe would make a lot of these institutions feel a lot more comfortable, kind of working with custodians like Copper. So talk to me about insurance. I'm curious how maybe the insurance process kind of works. I'm sure a lot of institutions ask about these kind of things, and what does kind of a coverage or something like that look like, for Copper and Copper clients?
Yeah, sure. So insurance is another topic that does come come very frequently with clients, and unfortunately, the insurance companies do understand its industry, but not in entirety, right? So even banks, as we discovered recently, that it's not 100% insured, and in the crypto industry, unfortunately, it's the same. We can get insurance from insurance companies. However, all the clients' assets are not going to be insured. We are, seeking for various insurance companies to provide as much coverage as possible. But again, this is the limitations of the industry as well. So, there are two types of insurance that custodians can get. There's the specie insurance that covers the physical assets that the custodians hold in terms of crypto assets. So it could be like a hardware security module, etc. Or in our case, it'll be the shards, the pieces of private keys. So these are held in devices where it can be insured. And then also there's another insurance called crime insurance that insures for criminal fraud. So it could be employee theft, it could be third-party theft, it could be cyber hacks, etc. So this is a what we call a crime insurance. So Copper has both specie insurance and crime insurance. For Copper, we have $500 million for the cold custody of assets. And then for for criminal insurance, we have 10 million per transaction. So if one transaction gets hacked, then there's coverage of $10 million. I mean, altogether, it doesn't seem like a whole lot. Because obviously the crypto custodians, secure more than a few $1 billion of assets. So that's only a fraction of what this insurance coverage protects. But again, this is not Copper's fault or any crypto custodian's fault. It's just a limitation of the industry.
Yeah, I completely understand that the industry as a whole just has these limitations. And I think that's another reason why this operational security model is just going to continue to be more important and grow. So on that topic of growth, I'd love to ask about kind of the Copper business and where you guys plan to grow from here. What are your guys' expansion plans, and how do you kind of see things progressing for the Copper business?
Yeah. So, Copper is a custodial service, but we're also a prime service as well. So let me tell you the difference between a prime brokerage and a prime service. So prime brokerage is a more broad term where, you have Morgan Stanleys of the world servicing institutional clients to have access to financial services, whether it be through providing loans or getting loans in order to short positions, all the post-trade activities that happen that institutional investors don't see on the side. And then on top of that, we have the soft services that I just mentioned, the white glove services where we provide capital allocators, your CVs and take them out for dinner and all that kind of stuff, right? So these are things that Copper would like to get into, but obviously we don't have a balance sheet. We're not going to the business of prime brokerage, but what we can do is provide that prime services. So prime services is excluding that loan piece, so we don't provide leverage to our clients, and then we also don't provide direct access to exchanges. Although we are integrated with various exchanges to provide them access, it's not under Copper's account. It will be with the the client's account. So if a client wants to trade through Copper with BitMart, they also have to onboard with Copper and then also with BitMart. So the exchanges can still have a direct relationship with the institutional clients that we have. So the post-trade settlement activities that prime services do usually is around when clients trade and making sure that the trades happen the prime broker to prime broker type of settlements, or it could be through custodians, and also let's say you have like a client that wants to go short on a certain position, and then we have long only clients that hold that position, and so that they can match make it, so they can borrow from that long only client to lend it out to a short a client that wants to go short. So that's one example, and also it's portfolio margining across different asset classes. So a lot of the institutional investors not only just do directional long only type of things, they go short on options, and they go long on futures, or they do something with like a short position on spot. All these things, if the positions are on, then you want to make sure that or the margins are set, and if one trade goes the other way, and you can use the other position to also kind of provide margin for that, so that they don't have to keep topping up margin themselves, but they can optimize that through different positions that they have. I mean, these are things that prime services do. Now, in the crypto space, one exchange can do that. So, as I mentioned, the exchanges act like a prime broker. So, you might have these portfolio margining accounts where, clients can have a long spot position and a short futures position. If the futures positions goes against them, they can use that profit or unrealized profit that they're getting from their spot position in order to, provide margin for that short position, right? So, you could do it on a one exchange basis, but in traditional finance, you could do it across multiple asset classes, right? So therefore, the crypto industry has that kind of limitation where you're really limited to one exchange because the other exchanges, work independently, and there's no prime brokers that service all the exchanges, right? So I think what the industry would really like to see, and especially coming from our institutional clients, is that if I have various positions on one exchange and I have various positions on another exchange, I want those positions to be reflected across the board rather than just with one exchange. So this is called cross-exchange portfolio margining, and this is probably the holy grail that the industry is kind of trying to work towards, and it will only happen if the industry participants can actually work together and also have prime brokers in place to make that happen. And it might not be just the fault of the exchange, or it might be not just be the fault of the lack of prime brokers that are in this space. We all are working to make piece of those products become a reality. And then Copper, what we're trying to do as well is that as we connect more and more exchanges to our product, then we can kind of provide that prime services in that sense, where you can actually do a cross-exchange portfolio margining become a reality. And right now, we have announced integrations to our ClearLoop product with BitMart, but we also have various exchanges, existing exchanges within our ClearLoop product suite, so that we can potentially in the future be able to do that kind of cross-exchange portfolio margining. So that's one of the things I wanted to kind of explain a little bit about, because I think a lot of the institutional investors feel that this is lacking in the industry, and then I'm sure there's a lot of people within this audience that doesn't really know that there are demands like this in the industry as well.
Yeah, I love that you mentioned the holy grail, which is like this true kind of most pure form of capital efficiency that was really going to unlock a lot of that traditional financial institutions and get a lot of that volume, to our industry, which is kind of a lot of these prime services and that true kind of cross exchange, cross margining. I definitely, I couldn't agree more that that's kind of this holy grail that everyone is kind of looking at it, and I think we're pretty close to getting there. I think there's just a few key pieces of infrastructure needed and a little more communication across the industry, and I definitely think Copper's playing a huge role in that. So I love the delineation between kind of prime brokerage services, which is just like this traditional kind of margin service that a lot of exchanges offer independently, and then this prime service, which is kind of this middleware that I kind of see it as, that helps unlock a lot of the benefits without necessarily taking on a lot of the risk that comes along with a lot of that prime brokerage services. So you brought up ClearLoop there. I'd love for you to kind of I'd love for you guys to give the audience a little bit of a primer on like what exactly is ClearLoop and how does it kind of function in the larger kind of Copper service spectrum.
Yeah, ClearLoop is a product that we launched in June 2020, and it's been a long time that we've been running this product. In a nutshell, what this is that clients in how crypto is traded, you have to move your assets on chain to an exchange. However, this poses a centralized risk at the exchange. We've seen a lot of times where exchanges go insolvent, or owners running away with the money, etc. I mean, these happen quite often still in this industry, unfortunately. So institutional investors obviously do not want to have this happen to their investors' assets. So therefore, we created a product where institutional investors don't have to pre-fund exchanges. They don't have to move their funds on-chain to an exchange. They could leave their assets with Copper and then have the trading capital reflected onto the exchange. So let's say a client wants to trade 10 Bitcoins on the exchange. We will ring fence, or we can lock those 10 Bitcoins inside the Copper's client's wallet. And then with the integrations that we do with the exchanges, we can, within milliseconds, we can send that information to the exchange saying that we have locked 10 Bitcoins inside the client's wallet and have that reflected on the exchange, so that when the clients go to the exchange, they can see that 10 Bitcoin allocated to their exchange account, and then they can trade based on that 10 Bitcoins. This part of the leg, nowadays, very recently, a lot of the other crypto custody providers are starting to offer as well. And I think it's a great thing, because this credit and debit balance is essential, because it increases capital efficiency. If you think about it, if you're not moving your assets on chain, you can save on gas fees. You don't have to wait for network validation. So that milliseconds of latency is increasingly important for a lot of clients, especially if they have to top up margin for their derivatives trades. They can't wait 10, 15 minutes for their funds to get to an exchange, because their positions might completely go against them and be liquidated. So this is extremely important. But Copper has taken a few more steps to ensure that even the unrealized P&L of that trade is also guaranteed. So we ask the exchanges to leave a balance with us in order to settle the trades with all the exchanges, with all the clients that are trading on that particular exchange. So you have clients that are having long positions and short positions. We net them off until we have this little shortfall of the trades that need to be settled. We ask the exchanges to leave a balance with us so that we can net off that shortfall, so that all of our clients can actually realize their P&L without having to wait for the exchanges to send funds across to them. So we always have a pool of assets that we monitor on a real-time basis, so that the balances are always there in order to net off the trades. That's the kind of post-trade settlement functionality of a prime services that we offer. And on top of that, like in traditional finance, there's a lot of trust structures in order to mitigate counterparty risk, even at the custodial side. So now, with this ClearLoop product, we have mitigated the exchange counterparty risk by not sending funds to an exchange. But also then, clients will be thinking, what about Copper's risk, right? What if Copper goes insolvent, right? So we created this trust structure so that exchanges assets, the client's assets, are put into this trust structure that is by English law, and then the exchanges and the clients are beneficiaries of this trust, so that even when Copper goes insolvent, the funds are sitting in that trust. It can't be siphoned away from Copper, because Copper is maintaining this trust as a trustee, and the exchanges and clients can use those assets to bring it back to their own entity. So you're not taking counterparty risk at Copper. So these are two extra legs that we've advanced our product so that to make sure that, one, clients' initial capital is protected, and then two, their unrealized P&L can be realized, and then three, they don't take counterparty risk at Copper.
Yeah, I think there's multiple levels to the importance of something like ClearLoop, right? Because it's not only about the capital efficiency aspect, but it's clarity. It's a little more, and that's why I love the name ClearLoop, because it really demonstrates how important it is to have this space and this structure where you can one, increase capital efficiency, two, you can have a place where you're reducing the counterparty risk, and three, you're having an open environment where people can kind of have this better execution in the post settlement environment. So you're having like a kind of tertiary levels, like secondary and tertiary levels of benefits, and then all with this goal of like increasing capital efficiency and making a better trading environment for institutions. So we're kind of getting a little bit up on time, but there are a couple more things I definitely want to harp on, which is you have this really unique view, being competent, being this kind of head of APAC, into kind of the institutional side of the industry, right? So a lot of the people that, like myself and like a lot of traders on BitMart are a little bit in this like retail section of the market, or we can maybe categorize as retail. So I'd love to get your opinion on what are you seeing in the institutional side of the industry? And what are some of the behaviors that you're seeing, and how do you kind of see this whole side of the industry that maybe a lot of us on the retail side don't really get a clear view into?
Okay, so I think a lot of it I've already explained in terms of in clients wanting to have a professional setup, or I would say institutional setup, so that you have all these the traditional financial infrastructure put in place for the crypto industry. So they want prime brokers, they want custodians, they want to have maybe even a centralized counterparty to settle the trades as well. So they're called clearing houses for commodity space. You can call it a settlement agency, etc. I mean, so those players, need to be established in order for wider adoption of institutional investors. So this is something that as a base case people do want. And then on top of that, now they get access to the exchanges, they get access to the crypto assets. Now what do they want to do? They want to be able to trade as they usually do in the traditional finance space. And I mentioned about cross exchange portfolio margining. That's something that all the institutional investors would like to see in the future. A lot of the spot trades nowadays are becoming off exchange now and going into OTC, as well as like options and other derivatives as well. So OTC brokers in this space are now starting to provide that service where they can be the counterparty for structuring options, structured products for clients that need various varieties of products in the market. So what do they need? They'll probably need a collateral agent to hold that margin for those OTC brokers. I mean, this is also lacking where copper can fit into that space as well, where we can hold the collateral or the margin as a collateral agent or an escrow service, so that OTC brokers and the institutional investors can trade with each other. And then this is more crypto native, but people do also want to get into DeFi. Obviously, the DeFi space, as you know, is not centralized. So therefore, institutional investors are a little bit worried about their funds getting mixed with, funds that are not KYC'd. So there are, DeFi products protocols being, adding the layers of permission or permission KYC so that institutional investors can come into this space. But obviously, the liquidity is still not there yet, so that there's mainstream adoption of DeFi. However, institutions are interested in that space. They do want to get into that space. Even, like the Central Bank of Singapore is experimenting with DeFi in the tokenized security space using DeFi. I mean, there's a lot of interest in that space, but yet, the industry is still a little bit immature to get institutional investors comfortable to get into that space. Staking is another thing as well. Staking, because you create yield by placing or staking your assets. Some countries deem it as a different type of product that needs to be registered as some kind of security. So that needs a little bit more understanding by the regulators, so that they can understand staking is not the same as like a collective investment scheme where you put in your assets and then it generates yield on a different way. I mean, this is a network staking, so it's a little bit different as a concept, right? So these things, even though the institutional investors understand it, they still need to get regulators to understand that even further so that they can have access to it. So there's a lot of things that the crypto industry is innovating and creating something new that regulators and institutional investors need to catch up on and make sure that they can also provide that return to their clients.
Wow, I think there was so many important bits of information in that last answer. I think you hit about the importance of structured products, and a lot of these larger institutions are kind of looking for more structured products. I think that's something, we've really only seen kind of perpetual futures and things like that, but I think that options and things like that, it sounds like are going to have a stronger comeback as more institutions get into space. I think you bring up a great point about institutions are looking to get into DeFi. I think that's incredible alpha that you've given us, and they're looking for a little bit more of the kind of KYC side, and maybe they're looking for maybe more kind of permission DeFi, so that they have some of the safety and KYC AML of some of the funds that they're working with. And lastly, I think you bring up that awesome point about staking. I think that's, at least for us in the US, there's been a lot of discussions about kind of staking and the impacts of that, and whether assets that require staking or that have staking components to it, whether those are securities or not. So I think that's a larger discussion to be had, but it's super interesting that you have this very important view into this entirely separate side of the market, where you're dealing with kind of large institutions, billions of dollars, legacy institutions, and that they're looking at a lot of the same things that we're looking at: DeFi, staking, infrastructure, and a lot of those things. So I think that's a great place for us to begin sending off. I think there was just so much alpha in that last answer. So I really appreciate your time, Taka. Is there anything last that you want to kind of double down on, mention, or something you want to leave the audience with?
No, not particularly. I think I kind of said everything I needed to say. But as institutional adoption start to happen, I mean, they are looking for areas that they can make money, right? And making money on the crypto side is always something that's always going to be there, because the industry's innovating and creating many ways that they can provide this decentralized finance for people who are interested in the space. But also, what the industry also needs is that infrastructural side to make sure that it's not that it is institutional grade, so that they can have access to it, along with their AML and KYCs and all the regulatory stuff along with it. So we are just in the first couple innings into this, and I think that there's so much more space that the industry can grow into, and as I say, we're still just the beginning part of it. So very excited to see how this place evolves, and thank you very much for inviting me to this AML, and hope I've been able to explain everything clearly so that all of your audience can understand how this industry is evolving.
Yeah, this has been incredible. I think we loved kind of hearing about the larger kind of Copper brand and what you guys are focusing on, and then getting more granular about how Copper differentiates themselves from other competitors. And I think you bring this incredible insight into this institutional space that none of us really get a deep look into. But I think the one thing that the big takeaway here is that the institutions are coming, they're interested. They're very. I think the space is. I totally agree. Very premature. We are still in the early innings, but they are coming, and I think that makes a lot of us who've been in this space for a while gives us another sense of confidence that this isn't just some kind of play internet money. That this is actual real financial innovation that's happening, and this is going to be the substrate for the future of finance globally. And so, I couldn't be more appreciative of the insight that you've given us. I think that, if anyone wants to learn more, you should definitely check out copper.co. I think there's a lot of great information and educational resources there about some of the things that, you guys help out with on the institutional side. And yeah, again, I really appreciate the time. Is there anywhere that people can support you for giving us your time? Anything you want to kind of drop or mention before we leave out?
No, well, if you want to know more about Copper, obviously it's copper.co. I have that in my name tag there. You can find me on LinkedIn, and I think that will be the best place. I mean, Twitter and all these things obviously are available, but for the institutional people, I think that LinkedIn is the best place to find me.
Definitely. So appreciate your time again, and appreciate the audience for joining us. This has been incredibly informative and a really interesting, very different look into a whole different side of the industry that maybe a lot of us don't get a lot of access to. So again, I appreciate the time. We couldn't be more excited to see the future of Copper and the growth. And super excited.
Thank you very much. Yeah, thank you.